The word derivatives can sound super intimidating, right? Like something only Wall Street geniuses would understand. But honestly, they're just tools, and they're built on a really simple idea. So in this explainer, we're going to strip away all that jargon and break it down into pieces you can actually get your head around.
All right, so let's jump right in. Here's the plan for what we're going to cover. We'll start with the absolute basics, what a derivative even is. Then we'll look at the two main types, futures and options. After that, we'll see who uses them and why, explore just how big their world is, and finally, we'll talk about the serious power and the serious risks that come with them. Think of it as our path from, what on earth is that, to, okay, I get it now.
Okay, first things first. Let's tackle the biggest question right off the bat. What is a derivative, really?
Okay, picture this. Let's say you're running an airline, and you've got to buy a ton of jet fuel in, say, 3 months. The problem? You have no clue what the price is going to be. Or, hey, maybe you're a farmer, and your wheat won't be ready for harvest for another 6 months. How do you protect yourself if the price suddenly tanks? That uncertainty right there is exactly the problem derivatives were invented to solve.
And the answer to that problem? It's a derivative. It's simply a financial contract. The key thing to remember is that its value isn't just pulled out of thin air. It's derived from something else, what we call an underlying asset. That something else could be a stock, a currency, a commodity like oil, basically anything that has a price that goes up and down. It's a way to manage that future risk we were talking about. Okay, so now that we've got the basic idea down, let's talk about the two main flavors you'll run into. They sound kind of similar, futures and options, but trust me, they work in totally different ways.
And this is the absolute key difference, so listen up. It all comes down to an obligation versus a right. With a futures contract, you're locked in. It's a commitment. You have to buy or sell at that agreed-upon price. No ifs, ands, or buts. An option, though, that gives you, an option, a choice. You have the right to buy or sell, but you're not forced to do it. Big difference. Diving a little deeper into options, you'll hear two main terms. Calls, which give you the right to buy something, and puts, which give you the right to sell. And their price is actually made up of two different parts. There's intrinsic value, which is any profit you'd make right now. And then there's time value. You can think of that as the premium you're paying for potential. It's the value of the chance that the price might move in your favor before that option expires. Okay, so who's actually using these things? Well, it pretty much boils down to two main groups of people, and they have completely opposite reasons for being in the market. And this is where you really see the two sides of the market come into play. You've got the hedgers, think back to our airline or farmer. Their main goal, to get rid of risk. They want certainty, they want to sleep at night. And then you have the speculators. They're the ones who say, hey, I'll take that risk. They're betting they can predict which way the price is going to move and make some money off it. It's a perfect system, really. One person's unwanted risk becomes another person's potential opportunity. Let's make this super concrete with our farmer example. So, the farmer's worried wheat prices are going to crash by harvest time. What do? They can sell a wheat futures contract today. This locks in a sales price for them, right here, right now. It doesn't matter what happens to the market price in a few months. Boom! They've just offloaded all that price uncertainty onto someone else. That's hedging. And believe me, this isn't just about farmers and stocks. The derivative universe is absolutely massive. A lot of people hear derivatives and immediately think of the stock market. And sure, that's a big part of it, but they exist for pretty much every major asset class you can think of. Currencies like dollars and rupees, commodities like oil and gold, even interest rates. They are literally the building blocks of the entire global financial system. So all this power and reach, it brings us to a really, really important point. Derivatives are a classic double-edged sword. With all that power comes a whole lot of risk. If there's one word you need to understand when it comes to the risk of derivatives, it's leverage. What leverage does is it lets you control a huge position, a lot of an asset, with just a small amount of your own money. Now that sounds great when things go your way, right? It magnifies your profits. But it also magnifies your losses. A tiny little price move in the wrong direction can completely wipe you out. It's that powerful. And trust me, history is absolutely littered with cautionary tales about this. When you combine the misuse of derivatives with way too much leverage, you get the recipe for some of the biggest financial disasters we've ever seen, costing companies and investors billions. This isn't just some textbook theory. It's a very, very real danger. So to stop that kind of chaos from happening all the time, there's a pretty robust safety net in place. You've got regulators like the CB and RBI who set the rules of the game. The exchanges themselves provide a structured, transparent marketplace so everyone can see what's going on. And then, and this part is so important, you have clearing corporations. They act as the ultimate guarantor, stepping into the middle of every trade and guaranteeing that even if one party defaults, the whole system doesn't just collapse like a house of cards.
So where does that leave us? Are derivatives these amazing tools for progress, or are they just complex weapons of financial destruction? Well, the truth is, they're neither, and they're both. They're just incredibly powerful tools. In the hands of our farmer, the hedger, they create stability and predictability. But in the hands of a reckless speculator, they can cause absolute chaos. So at the end of the day, their impact, for good or for bad, all comes down to how they're used, how they're regulated, and maybe most importantly, how well they're understood by the people using them.